Apollo Global, with $500 billion under management, says that the next decade could be one of the biggest booms in U.S. history. Ray Dalio, the greatest hedge fund manager in the world, possibly the greatest hedge fund manager in history, says we're headed for a debt spiral that could lead to something worse than the Great Depression. Two of the sharpest minds in the financial world, looking at the same data, are making completely opposite conclusions. But here's what people miss. It doesn't matter who's right in the next 12 months if you're positioned to win over the next 12 years. So today, Aaron and I are going to break down what actually matters if you're investing capital right now. And we want to walk you through an easy to remember acronym framework to keep you focused and keep your head in the game when investing your own money so that you can sleep at night no matter what the headlines say. This is On the Exit. All right, Aaron. So I was reading some quotes from Ray Dalio. Mm-hmm. You know Ray Dalio, he's like the god of fund the god. Managers. Ray Dalio, the hedge fund god.
He invented
I was going to say the GOAT. I was going to say the greatest of all time.
We'll bring him down a little bit.
Yeah, we'll bring him down. Ray Dalio, if you're listening to this, you probably are.
He invented the word fund.
We know that Ray Dalio is an avid listener of Own the Exit podcast. And so Ray, we're sorry, but we can't call you God. But you are the GOAT, and you have been pretty accurate in predicting some things that have happened in the economy. And right now, I mean, Aaron, he was quoted in Reuters as saying, I think that right now we're at a decision-making point and very close to a recession. I'm even worried about something worse than a recession. We're having profound changes in domestic order, and we're having profound changes in the world order. Such times are very much like the 1930s.
Yeah.
So Ray Dalio is basically saying his perspective is that we are headed toward another, not just recession, but possibly Great Depression. How does that hit you?
It's tough because there's always those competing opinions. You think about, economists, some of them want to give all the money to the government. They want to tax the heck out of everybody. Big government. Let's give it all to the government so they can help the economy, and then there's, the trickle down where it's, give it to the rich, and they'll buy more stuff. They'll hire more people. They'll invest more. And people are they fight over those different economic theories.
Yeah.
And I think you see it over and over again where no one can predict the future.
Yeah.
It's always just back and forth. So it's something that I personally would consider and weigh that up and obviously listen. Right. But I don't know if I can, I just don't know. He doesn't know.
Yeah. I think
that's one thing that history has shown us over and over again is the experts are continuously wrong.
They're continuously wrong. I mean, and I'm not saying that he's wrong. He's actually been pretty accurate in his economic predictions, especially positioning investments. I mean, most successful hedge fund manager in history, probably. But then you've got other massively successful, asset managers, capital managers, hedge fund managers, private equity groups like Apollo Global that are kind of they're all looking at the same data points. They're looking at the same news headlines. They're looking at everything that's happening in the world. They're crunching every single thing. They've got teams of data analysts. Apollo Global is saying the next decade could be a boom.
Yeah.
And so, I mean, it's just competing opinions, but everyone's looking at the same data.
I mean, everything even as simple as, just looking over the last, from the crash, the global recession back in, with the housing crash in 2009, a couple people kind of saw that, but not very many.
Right.
And then after that, that was a once in a lifetime opportunity to buy real estate.
Yeah.
Most people didn't really see or really capitalize on.
Yeah.
Why not, right? Maybe it was fear. It was they had just gone through a rough time. So now it's, man, I got to steer clear of that. That's crazy. I don't want. Meanwhile, it's the best buying time, right? And then all through the teens, everything started to get crazy. And, then COVID, right? No one could see that coming.
Yeah.
And then the interest rates and then, the correction, to, doubling or tripling the rates, which people didn't really see, even though looking back, it's so obvious.
Yeah.
It's, the rates were slashed 2 to 3%. Obviously, they're going to need to swing those back and overcompensate.
Yeah.
And it went on for much longer than people predicted just in our industry. We thought the Fed was going to be slashing rates last year aggressively, and even the year before that they would start, and they kind of did, but not really.
Right.
And so it's so easy. When you look back, you're kind of like, yeah, I can kind of see how it all kind of makes sense. And like, I could have positioned myself back then. I could have done this or that. You know, shoot, I could have bought Bitcoin in 2013, right?
Yeah, yeah.
But the future is just so hard to predict, you know? And
you also could have probably bought Blockbuster stock too and lost everything. So the point is that there is no crystal ball. There's data, there's analytics, but it's also important, I think, to recognize that in a recessionary environment, like when a recession happens, or even, you know, God forbid, another Great Depression happens, it's not like all of the money in the economy just evaporates and goes away. It just moves to different places. Right? That's what happens.
It creates opportunities.
And so when I look at it, if I think of, okay, and I'm not questioning anybody's intentions or motives, okay, but what I am saying is if I, you know, have trillions of dollars or billions, you know, hundreds of billions of dollars that I have under management as an investment firm, capital management firm, hedge fund, whatever, then I actually like recessions and pullbacks because that gives me an opportunity to buy assets at discounts.
Right.
And transfer wealth from those who are afraid to make moves in those environments to me, who thrives making money in those environments. I'm not talking about me. I'm saying if I'm the hedge fund guy or the guy who can go out and acquire assets when they're trading for discounts. Yeah. And so when I look at it, I'm like,
say that the economy is going to, would Ray Dalio be saying that would that narrative benefit him from an investment standpoint as a hedge fund manager?
I would imagine
by saying that.
Right. He's made a lot of money every time the economy's taken a downturn. And I actually like his stuff. And I'm not questioning his intent, but I'm just saying for him saying there's a coming recession, he's viewing it from a totally different lens. There's part of him that probably actually, at some level, hopes that it happens a little bit because he knows it's another opportunity to really capitalize on a market with major discounts as an investment guy.
And there is a lot of fear and uncertainty and concern, like genuine.
Yeah, totally.
With the debt spiral and you can't, how do you tame that? How do you rein that in at this point?
Yeah.
You know?
Yeah. I think Ray was saying that the U.S. debt is like 6% or something like that of GDP. And in order to avoid, the federal deficit is around 6% of GDP. And so he thinks that it's got to fall to 3% in order to avoid a real financial crisis. So
gotta get Elon Musk back in there.
Yeah, exactly right.
I don't think he really helped too much.
He worked for months and
he saved like $200 billion.
Yeah, which $200 billion is nothing to shake a stick at, but
it was a little short of the $2 trillion.
That was the goal for sure.
But yeah, I think there's concerns, but I think there's also opportunities in the midst of those concerns, right? If you're positioned well and you're protected against those things. So yeah, it's a shifting landscape for investment, and guys like Ray Dalio. Obviously, we listen and really listen, but also try to weigh that up, with just other experts and not try to time the market. Right. I think you just have to, like you said, people are worried about the next 12 months, but what about the next 12 years? And just being positioned long term for success, and being able to ride through those.
Absolutely. Absolutely.
Those storms and uncertainties, and the media is just brutal.
Yeah.
Sometimes I just like to turn all that stuff off.
Yeah.
And just realize, hey, there's actually a lot of sound fundamentals in a lot of these asset classes. And the basics are there, and no one can predict the future. But if you're in good, quality, whether it's hard assets, whether it's well-managed, businesses with track records or whatever you're investing in, having those, where it's hey, I don't know what's going to happen in a year or 5, but I'm in these quality assets, right?
Yeah.
Quality investments.
I think that's the important thing is, post 2008 global financial crisis, if you look at correlation in publicly traded assets, right? They were all you could achieve diversification before 2008, right? From like 1988 to 2022 or 2007, from 88 to 2007, you know, correlation between different asset classes and publicly traded markets, it was possible to achieve a diverse portfolio. 60-40, you know, publicly traded portfolio was actually diverse, which means you were protected from downside risk in the event of a recession, in the event of economic pullbacks, years with drawdowns in the stock market, your bonds would carry you, all that kind of stuff, right? And so when '08 happens, though, you've got all these coordinated central bank policies, quantitative easing, you know, stimulus packages, you know, propping up assets, the government, and all of it created this sort of risk on, risk off behavior in the investment world, where now, and then you have COVID that happens and it exacerbates it even more. And now you've got the whole AI age and all these AI trading algorithms that exacerbate it even more. I mean, an AI model doesn't treat a stock different than a REIT, right? And in some of them, they don't even treat bonds differently. So everything's correlated. And the reason that's important is everything goes up and down together now based on risk on, risk off trading behavior, which means risk on, everybody's, you know, feels like the economy is stable, everything's going good, everybody rushes into equities, bonds, commodities, emerging markets, futures, everything like that. And then when everything seems not stable, everybody runs into cash or US treasuries or, you know, sometimes gold.
Right, back and forth. And so you can't achieve that same diversification that's
so everything moves up and down together. Yeah. So the point is,
it's funny because that's why people are in the public markets.
They want to be diversified, but they're not. And it's impossible. It's statistically impossible. I mean, if you're holding a public market portfolio, then, you know, indexed to the S&P 500 on your equities, then you've got like something like a 17% volatility in your portfolio, which puts you in a hyper aggressive position. And you're not necessarily getting hyper aggressive growth.
Right.
So the point,
all the drawdowns and the compounding doesn't. You're playing catch up, right? You're just trying to get back to your original.
Every time there's a drawdown, it's going to take a couple of years just to get back to
5-10%.
Yeah. And so the point is the miracle of compounding interest, buy and hold in a diverse stock, you know, publicly traded portfolio, like those days are gone. And so the point is that if that's where your investment portfolio is, then a recession is terrifying to you, because you know it's going to take you forever to recover. But if it's in hard assets, you know, you've got some allocation into hard assets. And this is why, you know, years ago, I shifted from primarily focusing on, I was actively trading the stock market. So I was treating it more like a business than just an investment.
Right. Yeah, active
perspective. And I actually did really well. It was great. But over time, I mean, life situations came up. My son, you know, I've shared that story before. My son got super sick and, you know, had a serious medical crisis, and it took me out of the game for 4.5 months, lost 40% of my portfolio in 4.5 months, and realized that the hard assets I owned, the real estate, for example, that I owned, those were the only things that were working when I couldn't work it. And so I began to slowly allocate and educate more into the alternative investment space. And what I learned was insane. And it's that the ultra wealthy, like the ultra wealthy people that really like have grown significant asymmetric wealth through investing, they're not investing in the stock market. I mean, they're over, what is it, Tiger 21?
Yeah, Tiger 21 is, you know, you have investable assets of $20 million. It's a kind of a member, it's like a mastermind kind of networking group. And they've got, I think they release their annual asset allocation across members. And so people with a net worth of 20 million and up, these are either high net worth or family offices, which a family office is basically just you have a net worth that's large enough that you need to have professional management on your own money. And so to figure out how to invest it, right?
Basically start
it's
your
too
own
much work to figure out how to manage it all and invest it when you have that much and you're just, it's your own money. It's nice.
Yeah, absolutely.
But there, I think it's 29% in private equity, 25 to 30% in real estate, and then 11% last I checked was cash. So they're holding a lot of cash too.
They're holding a lot of cash right now. So
So-
the wealthy are holding a lot of cash. So I'm thinking,
if you got 20 million, it's like you have $1 million cash, or they're not trying to get a return on that. I think there's the value of liquidity, especially within just uncertainty in the environment and economy and stuff like that. It's
want to have cash.
good to have some cash on hand, but
Part of it's want to have cash to make sure that you're good, but that's not why these guys have cash in their portfolio. They got cash in their portfolio because
Take advantage of opportunity.
they want to sit on some dry powder,
Yeah.
and be ready because they know that opportunity is going to be there. As there's fear in the market, it's time to get greedy. That's the time to buy. And so, I guess the point that overall that what we're talking about right now is that whether Ray Dalio's right or Apollo Global is right or somewhere in the middle, a guy I met and had a conversation with in a mastermind who is, one of the chief economists at, what's the name of the company? ITR Economics. They have a 95% accuracy track record in predicting future economic movements.
nice.
And he's saying, and, has tons of data to back it up, that the next 4 to 5 years, maybe even 6 years up to 2030, 2032, we're going to be, there's a runway.
Good
and
runway.
then but then there's some things that, that are teeing up to happen post that will.
But 5-6 years in the future, I mean, I know they're right 95% of the time, but even that is like, to what extent, right?
Right. But the point is that we are like in a window where we could take advantage of some really good opportunities right now and be positioned to take advantage of some phenomenal opportunities as we get into, the early 2030s.
Even Ray Dalio too, with the debt spiral, and I don't disagree. I think about it, but how long, right?
Right.
Because even if he's right, there may be a timeline there, for that happening, right?
Yeah.
Where it compounds and becomes more and more unsustainable, and there's just a giant meltdown.
Right.
But
if you think about it like this, there's a period of time where if your family's finances, if you're fiscally irresponsible, right, but you still got income,
right,
you still got all that, you can continue to live beyond your means for quite a while.
Yeah.
Just running up credit cards, right? Because it gets, like you can do that. And then, but at a certain point, it breaks. It gets to the point where what you owe
you can't pay it.
There's no possible way you could ever pay it back. And I think that is where the U.S. government is right now. Like I can't imagine the government ever being debt free.
They could sell Alaska.
Yeah, they could sell
to Putin.
Yeah. Oh man, that's a terrible idea.
The amount of, I'm joking, but
I know.
The amount of Canada would be like a sandwich in between Russia and U.S.
Yeah.
It wouldn't be good.
Yeah.
But there's so many hard assets in the U.S. Just I think it's like the amount of value of all the land and natural resources and all of the offshore like drilling and minerals and it's 10 times the national debt.
Yeah.
But it's just tapping into that, right?
It's
but it's scary. But
the point is that the debt issue is a real issue, and it is something that as Americans we should be concerned about. But
yeah, for sure. But how long, right? And then what steps can you take? And I think back to the Tiger 21 thing, I think these guys are positioned in a way that can ride through, they're going to be in the best shape. And you don't have to have $20 million in investable assets to kind of do what they do.
Yeah.
Right. So I think if you're like, oh, those guys are just, I only have $1 million or 10 million, or I'm not there yet. And it's, you could at least kind of model your financial plan and your investing after off people that are more successful, right? And a lot of those guys didn't get $20 million by investing. I would say most didn't. They got it through business.
Yeah.
They started businesses, or it was multi-generational wealth. Those are kind of the two ways you get money.
Right.
But then what do you do with it?
Right.
Well, these guys are putting 30% into private equity and 30% into real estate, 30%. So I would just say for the average person, do you have 25% of your investable assets in real estate?
Right.
And private equity, or do you have it all or you just got it all in your public markets?
And I would say, and just from a data standpoint, allocations into all private alternatives, including real estate, private equity, venture cap, all, infrastructure, all of that, for the average investor in America, it's 2% of their portfolio.
Oh, really? 2%? Wow, that's
of their
crazy.
portfolio is allocated to that.
So what caused
So if you're listening to Own the Exit right now, and you're investing at all, then odds are you're investing about 2% of your total net worth and holdings into things that actually are far less risky if you play them right than in just investing it all in the stock market. And that's the thing is that's the lie that almost every investor believes is this lie that they've been sold by Wall Street, that investing in, or the lie that they've been sold by their financial advisor, it's that investing in public markets is safer than investing in private alternatives.
Which is funny because most of the people, I've always been a proponent of real estate. I've always been super real estate heavy, like maybe too heavy, but I love it. And I'm like, cash flowing assets, blah, 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 the leverage, all the stuff we know about it. And I've met with multiple financial advisors that discourage that. And no one's ever said that was bad except for financial advisors.
Right.
Like I've had conversations with business people and other like normal people, and everyone's, hey, that's great. But then financial advisors that I meet with, they're like, no, man, you can't, it's too risky, or buying a rental property is going to be a huge nightmare. And I'm like thinking, well, that's not what the people that have net worths of $20 million or more are doing.
Yeah. And I think, and
it's not all financial
not
advisors.
All financial, but most. And the reason is, number one, financial advisors are incentivized to increase assets under management on their platform. Right. Number two, the average financial advisor in America makes $102,000 a year. So they don't have any real wealth of their own to even know to look elsewhere.
That's kind of the lowest area,
paycheck
like when
to paycheck. Anybody, in the middle class. So it's there is no.
You kind of go for the normal kind of the normal course, what they tell you to do, right?
Yeah.
To do the W-2 job, go into the retirement, go into the retire at 65.
Yep.
And I think that there's value in that as a starting point and as a base level.
To get yourself in the habit of actually investing. It's like I'm mentoring a 19-year-old kid right now. And we were playing golf the other day and we were talking about investing. And he's like, how should I start? I know you invest in all these like alternatives in real estate, stuff like that. Like, how should I start now?
And you're like, all right, bro, I'm 29% private equity, 25% real estate.
Absolutely not, because it's
11% cash.
It's too much for a 19-year-old, somebody who's learning this. If you've never invested in anything before, then step number one to me for him is open a Roth IRA. And your first goal is just max that out at $7,000 a year.
Absolutely.
That's step number one. Just start doing it in the lowest threshold way possible. That's your first goal, is max that out every year. Once you get that to $50,000 or $100,000, and you can do that in just a few years, like that won't take that long. Maybe by the time you're 26, 27, you could have 150 to 100 grand in there that you just money that you've put in. Right.
And the tax benefits and everything.
Yeah. The tax benefits, all that kind of stuff. I was like, then once you actually have a little bit of capital, then start looking at diversifying a little bit into alternatives. Take that, roll it over into self-directed IRA. But when you start, just take the lowest barrier to entry to get started. But most people, they're not starting brand new. If you're listening on the exit and you are, 18, 19, 20, 21, you're trying to start a business, trying to figure out like how to invest, all that kind of stuff. Like the best thing is just start somewhere. It doesn't really matter at that stage.
Totally agree.
But if you've owned a business, you're creating cash flow, you're looking to own your exit, then you better freaking stop listening to the Wall Street machine and actually educate yourself and become your own financial advisor. Because nobody's going to be incentivized more than you to grow your wealth in the right way and with the least risk and the most stable, predictable outcome. Nobody will ever care about your wealth and your family's wealth more than you will. So if you're just trusting it to some guy in an office that makes $102,000 a year to tell you what you should do with your money that you worked hard to earn, then you are being irresponsible. That is my opinion. And it's a true opinion. It's accurate and it's 100% gospel truth. So it's not my opinion.
Gospel according to Caleb.
The gospel of Caleb. No, it frustrates me how much like business owners who are they're like baller at building businesses that create income and all that kind of stuff. And then they just invest in what some barely 6 figures guy who's making 1/10 of what they make.
Yeah.
They just trust that guy to tell them what they should do with all the money they work their off to make.
Right.
And it's frustrating. It's frustrating for me to see people caught in that kind of situation.
Yeah. And the same thinking that is required to have a successful business, and adaptability, learning, and being challenged. You need to do that with your investments too.
Yeah.
Because eventually you want that business to go away and it be that income to be replaced by the investments. And so you have to be just as smart on that.
Yeah.
Because unless you just want to work forever. In your business, right?
Yeah, absolutely.
So, but
and maybe you do, and that's fine. But then, if you're working in your business forever, it's probably creating cash flow. And what are you going to do with that cash flow?
Yeah.
You would still want it to grow. You still want it to grow and do more stuff. So
there was an acronym that you were going to share at the beginning.
Yeah, absolutely.
Just to run through that.
So basically, regardless of what the economy is doing, you want to keep a balanced, steady head about things. And this kind of acronym is just a really simple way to help you keep your head in the right place so you can sleep well at night and be sure that you're making decisions based on what's logical and not just the emotional ups and downs of doom scrolling on X or on Fox News or CNN, right? And so
doom scrolling.
Exactly.
Yep.
The acronym's P.R.I.M.E, P.R.I.M.E. It's first when you're kind of getting inundated with all the headline noise around the economy. Start first with the P, pause. Pause, step back from all the market noise, from all the headlines, shut down X, shut down CNN, shut down all that. Just pause, take a moment before making any moves. Don't sell off and don't go out and buy until you've paused first. Then review. Look at actual fundamentals, especially if you're investing in alternative assets, hard assets. Look at the actual fundamentals. The fundamentals in publicly traded markets, they don't even matter anymore. Amazon had its best earning report in Q1 of this year, and then the macro headline of tariffs caused their stock to lose value, like drop 12%.
Right.
Their fundamentals were strong. Their earnings were strong. Everything you would want in a company was
but it was
strong,
just the thought of the tariffs.
But it's the macro headlines. That's what drives the stock market, not the fundamentals.
Sentiment and these economists with these varying opinions in the news that just
exactly. So reviewing, fundamentals on public market investments is not nearly as beneficial, but taking a look at fundamentals in the alternative space, the private space, what are businesses actually doing? Is if it's in multifamily real estate, like what we do, is there demand? Is there rent growth? Is occupancy trending up and is it already high? All those kind of things, like the fundamentals of the actual asset. Is it strong in the market that you're looking at? So review fundamentals, assess the actual fundamentals, not the headlines. Then the I is identify, look for opportunities to buy mispriced assets or sectors that are more poised to be resilient. And I like to ask the question, everybody runs towards the shiny object. So right now, for example, the shiny object is AI. Everybody's chasing, AI startup valuations in the private space. So everybody's allocating capital and stuff like that. I like to ask the question, what must be true in order for this shiny object to thrive? And the thing that I arrived at is there's going to have to be an increase in energy creation and production. And although nuclear could meet the demand, has the power, it's the only alternative that probably has the capacity to meet it. It's very expensive and it takes 12 to 16 years in some cases to actually build and get a nuclear facility online. And it's not a global solution because you have to, get through like non-proliferation and all that kind of stuff across. We're not just going to let Iran right now, especially, build a nuclear power plant because we've just destroyed all of their refined nuclear material. right? So it's just important to know, although nuclear could be a solution in the long term, 40, 50 years, it's not going to be the next decade or 20 years. It's not going to be the solution. So it's all going to fall back on mostly natural gas and oil. And so that's why I'm like, okay, if I'm going to identify mispriced assets that are still going to have, demand, that's why I'm investing in oil and gas. Because increased energy demand is a guarantee with AI. I mean, by 2030, AI will be using more energy than the entire country of Japan does in a year, right? And it's only going to continue to grow. So pause, review, identify, look for mispriced assets, then move. This is like the most important stage because a lot of people get stuck in analysis paralysis and trying to find the perfect thing. At the end of the day, if you've paused, you've gotten your emotions in check, you've reviewed, you've actually taken a look at real fundamentals and the fundamentals are strong, you've identified some mispriced assets, then you got to take action. You got to move. You got to start allocating if you actually want to see something work. And then the last time is evaluate, measure the outcomes. Look at it objectively. Look at and continue to improve and grow and start small and scale up from there, right? So that's more
awesome.
Education than it is, I'm not an investment advisor. That's more a good, solid, prime way to approach how to manage and step into, a hard asset portfolio, alternative investment portfolio, when there's a lot of headline noise and competing opinions about what the economy is going to do.
So pause, review, identify, move, and evaluate.
Yeah. Pause, review, identify, move, and then evaluate. And the M is ultimately the most important one because if you don't
take action,
a lot of people educate and they never take action. They never actually do the freaking thing.
That's true.
So
this has been a good episode.
Yeah, good conversation,
Yep, it's stuff that I think a lot of people were all thinking about, and worried, There's always that. I tend to be an optimistic person, but there's still those worries, of the future and the economy and how do I make sure I'm in a good spot, and so I think these are good things to think through. But knowing that we actually are, there's things that you can take proactively. You're not at the mercy of the economy or the market. I mean, there are different factors where you are, but there's also steps you can take to hedge against that, right? To be protected for your family, for yourself, for your portfolio, education, and taking these steps and just being aware and not buying into every new narrative or And I tend to think that even if there's truth to those, it's going to land somewhere in the middle from these extremist views. I think it may end up balancing out somewhere. It's like they say, it's never as worse, or it's never as bad as they say, and it's never as good as they say.
Yeah.
And I think there'll be somewhere in the middle where we'll be okay.
Yep. It's like the saying, nothing goes to performa, right?
Yeah.
Nothing goes to performa.
It's either better or worse.
It's either better or worse. And that's it. That is the extent of what economists and these people can predict about the future.
Predicting 5 years is...
They can... They're never going to hit it on the head. It's either going to be better than they say or it's going to be worse than they say. So at the end of the day, you got to position yourself with a longer time frame and a longer timeline to be okay either way.
Yeah.
And that's the whole point of, why we personally are, more diversified into alternative investment asset classes with strong fundamentals is because our portfolio, as it grows, continues to be largely uncorrelated, with the individual assets are largely uncorrelated with each other, which creates a lot less volatility, which means
either way we win.
Economic up or down.
Yeah.
Either way, stable, predictable growth over time. So
awesome.
That's it. All right. Thanks for joining on The Exit. We'll see you next time.
Thanks, guys.